private equity is not a silver bullet, and it's not a silver bullet for all.
My question is, do accounting firms really need capital?
At some firms that remain independent, that aren't interested in private equity but need capital, they have raised the capital requirement of equity partners. Even they've asked income partners to contribute. But there's lots of those people today that want and like a job with a steady income, but don't want the pressure, the stress, the risk, the unknown of being an owner.
Hi everyone, welcome to our podcast WTF. We are trying to figure out. Today we have with us, the man who is the center of every or most of the big boys deal that we do in the accounting world. And people flock to conferences to just hear me. We are bringing him in front of you. So please stick to your screen and watch till end. We would like to welcome Allan Koltin.
Thanks.
Allan, welcome.
Thanks.
We are here together in the PE Summit, and I just reached out, can we just have a conversation, do a podcast? And he was gracious enough to say yes and take the time out. So thank you, Allan.
Thank you for having me. It's an honor to be here.
Yeah, so Allan, and whenever any conversation comes to you, it would be world of accounting, world of M&A, and the recent phenomena of private equity,
Yes.
So my first question, I mean, you have done a lot of videos already. So people know about you, at least in our world. So I'm not going to kind of dive into your introduction, but just for everyone, just 1 minute, for everyone to kind of understand that, just give a background of how things are moving in the accounting industry in terms of M&A and PE. That would be great.
Yeah, it's insanity. I don't know how else to put it. I trigger June 30, 2021, which was only 3 years, 4 months, and 20 days ago. Not that long. And that was what I call the calm before the storm, because there was no PE in the accounting industry until that next day, July 1 of 2021, when Eisner-Amper accepted a private equity relationship with Tower Brook Capital. And then 90 days later, October 1, Citrin Cooperman entered into a PE relationship with New Mountain Capital. That was the placeholder for 2021. We called it the Great Lab Experiment. Never had been done before in public accounting. It had been done in insurance brokerage and wealth management and consulting and advisory. And there was even a big tax-only firm called Ryan Tax that did it. And the question was, would it work? And, it's 3.5 years later, and the early precincts would suggest it's been nothing short of a grand slam home run.
Yeah.
All that being said, 2 big caveats, if we could, just that'll guide our conversation. Number one is private equity is not a silver bullet, and it's not a silver bullet for all. And there will be a lot of accounting firms, small, mid-size, enormous, that will never go into a PE relationship and will do just fine. They will find a different way to create capital, which is, is a lot of why private equity is in. The fourth industrial revolution has hit the accounting industry right between the eyes. We need capital for talent, for technology, for transformation. And it comes at a time where most of us, we call it the golden age of public accounting, from 2020 to 2024, raised rates, got rid of crappy clients, reduced our second biggest line item called rent, right? People don't come in as much as they used to. And we made more money back to back to back years. So all of this comes at a time where I think we are living in the moment, maybe not looking strategically out. So the greatest 5-year run in the history of public accounting, as we look to the next 5 years now, 2025 to 2029, beware. What got us to the dance may not keep us, and private equity hence has just continued to come in. Big firms, mid-sized firms, small firms. But as you know, there's been other derivatives other than PE. which we can talk about as well.
Yeah. So picking a point from your that there is an investment in technology, talent, and but from my perspective, I'm just a little bit about me. I was an accountant back in India. I started my career in Florida, and then 8 years.
No way, you got way too much personality to have been an accountant. Come on.
Yeah, but that's a reality. So I have been an accountant. My question is, do accounting firm really need capital? And let me set the context here.
Sure.
And again, to set the platform here, we are looking at firms from 50 or rather 150 to 1,000 firms. So we are looking at mid-size and smaller firms. So anywhere revenue from 30, 40 million and below up to 4 million in revenue. And I've been meeting a lot of them. And there are a lot of questions out there around PE, around getting merged. And my questions would be coming in from that perspective about their cautiousness, that's their skepticism. So one question is, do we really need capital when it comes to talent or technology? We have seen accounting firms anywhere creating, especially these firms, anywhere having an EBIT of 25% to 30%, depending on how they are managing their business. Yes, the capital would be probably needed if you want to go aggressive acquisition route, or probably you are paying off retiring partners, which you have not kept reserved of. But do you really need capital for building tech when you are a profitable business in itself, or acquiring talent? That's one of the questions when I have read some of your articles and some things I've been talking to firm, and similar thing is coming from them as well, that they are asking me questions that we need capital, and I'm asking, you're already a profitable business. It's about deploying back. Mm-hmm. So the question is the risk appetite at that age not available to deploy capital and take home the money rather than deploying anywhere? So that's one of the...
that's like 9 questions in one you just asked. So let's do the simple one. If you believe you need capital, and then we'll go back to whether you need it or not. If you believe you need it, let's talk about the ways to get it. At some firms that remain independent, that aren't interested in private equity but need capital, they have raised the capital requirement of equity partners. Even they've asked income partners to contribute. So it's gotten as high as 1 times compensation. So if I'm an equity partner in a top 100 firm making $1 million, I got to leave $1 million of capital there. The second is, some have said, you know what, we're going to devalue the firm. We're going to pay less out on the deferred comp. It's too rich. Yeah. We're going to pull it back in, and some firms have done that. They used to have a multiple of 3.5 times your earnings, or 3, now it's 2 or 2.5. Some have said we're going to reduce the retirement age of partners. Some have said we're going to go to the bank and borrow money. We need money, but we're going to take debt. Everybody talks a good game on that one. Accountants don't like risk. They don't want to go to the bank and put their house up, as a mortgage. So there are different ways to create capital. Some would say just get more profitable so we can scrape some of that profitability before we allocate it to the partners. The sexy title is called an innovation fund. Before the compensation committee sees the dollars available to allocate, we've already taken 7-8% out of it so that we have the money for technology, transformation, M&A, et cetera, et cetera. So let's go back to your original question. Do they need capital? And the answer is, it depends. There's 3 kinds of firms out there. There's a firm that I lovingly call it Groundhog Day. I don't know if you ever saw the movie with Bill Murray, but you could go look at the trailer, and the day keeps repeating itself. We as accountants, not all, but half of our profession, we are what we call steady eddies. Yeah. We just want to grind and grind and grind, bill, until we can't. Yeah. And right now, the feeding at the trough, the last 5 years, all indicators are, I can just keep doing what I'm doing. So for every 2 accountants you talk to, one will say, PE isn't for me, I don't even know what all the chatter is about, why do you need capital? Can't you just keep doing what you're doing? The other side of the coin might say, well, if you want to grow a business and you want to be a destination place for talent, and you want to offer your firms, your clients, all of the services they want. We're not just a CPA firm, we're in the business of helping our clients with their business and financial problems, whatever they may be. They're going to go out and build those consulting and advisory practices. You can do it on the cheap. I can go steal somebody from a national firm and say, go build it, and 3 years later, their revenues are $200,000. Or I can go buy one. Now, if I go buy one, guess what? I'm competing against private equity. And they have something I don't have. They have check writing privileges.
Yep.
So it's a question of degree. Do I want to stay home and just keep doing what I'm doing because I'm making a nice living? Do I want to transform and stay as an independent firm but take a PE partner or go to the bank or get more capital? Because to build this, it does cost real money. You know, people say to me, we don't need capital, but we do have a succession problem. I say, tell me about it. They say, well, we got 4 partners leaving and we don't have the replacement parts. Matter of fact, the next gen, they're buried with work. So we don't know what to do. So I know what you're going to do. You're going to go steal a star from another firm. But that star is making $300,000 and has a $2 million book. And they've signed an agreement with that firm that says if I leave, I can't take the business. I could, but I'd have to pay 2 times the revenue, some absurd number. So I'm that person you're looking for. I'm going to solve one of your partner's succession plans, right? The problem is there's 4 other firms talking to this candidate, and the bid is up to $400,000, 33% higher than they're making. So if I end up winning it, I'm going to overpay and I'm going to get less. Because why'd that person get paid $300,000 for the $2 million book of business? I can't have it. The good news, I can plug them in. I call that capital. I'm investing in solving our succession planning problem. I call offshoring, right-shoring. I call that an investment if I want to go buy a facility. I could also do it a different way. I could partner with a great firm and find a way to get that work done. So it really is a strategic question. It's not for everyone. It's not intended to be. But I think for the firm that wants to 2x or 3x the business and not just grow organically 2, 3, 4% a year, probably something they should look at.
Yeah, thank you. And
Yeah.
yes, definitely we help the firm so they don't need to go by themselves, and we help them expand. So, but one thing that, so mid-market firms we are talking about, and mid-market firm has a smaller table, you know, of partners, anywhere from 3, 4 partners to maybe 10, 15 partners. For them, the confusion, I just talked about the confusion, do we really need capital? Second thing is, some of the smaller firm thinks that if 3 partners are going out, I don't want to be stuck in this relationship. Yeah. That's one. Yeah. So another situation is if PE comes in, then what would be our voice? Would that happen that we who have been founding partners or we have gradually came in? Sometimes, if 30-40% partners are retiring, then rest of the partners are thinking that we would be stuck in this relationship. So they kind of say that, we do not want this. So for mid-sized firms, the situation is there is first, the partner pool is not in the same retirement age. Some of them are younger, some of them are at the mid-careers, and some of them are in the later part of their careers. Mm-hmm. So considering their aging, their preferences are different. Some of them are looking at running the business for next 20 years, and some of them are going to retire in 5 years. So their needs are different. So this is one of the major concerns in this mid-market segment. So what do you think, how should they approach, or they should, again, there would not be one answer, but according to the situation, what do you think would be their approach to private capital, I would say?
Let me come back to why PE, because there's a whole concept there that has nothing to do with capital. The creation of enterprise value and wealth. Yep. But to that, let's use a $4 million to $30 million firm, 3 partners up to 15 partners. So I heard a little bit about succession. I heard older partners getting out, and in most firms that size today, there's not enough young ones to take it over. What those older ones will say to me is, we have people to do the work. Have you ever heard the expression finder, minder, grinder?
Okay.
The finder brings it in, the hunter, as we call it. The minder sort of owns those client relationships. The grinder is the one that puts out 1,800 chargeable hours, maybe doesn't have the personality to own the client relationship, not much of a rainmaker. I always have to remind accounting firms, they're not accounting firms. They're not audit firms. They're not tax firms. They're people businesses. And if you want to create a sustainable firm, there are 5 types of talent. Every decade, you have to repopulate. You know, in this business, if you don't grow, you die a slow death. You really do, because you end up holding on to stuff that sometimes is C clients are not that profitable, and you wake up one day and you say, we don't make any money. You know, I just have to say to firms sometimes, let's just pretend we're in business to make money. What a novel idea, you know? So the ability, the skill set to produce revenue, rainmaking, to own those relationships, to be so good that you can screw up an audit or tax return, client's not leaving you because you're not just the most trusted advisor, you're the most valuable advisor to the client. The technical skills, the industry specialization. The 4th bucket is the ability to recruit, retain, grow talent, right? Because every 10 years it's the food chain, the circle of life. We got to keep replenishing. And the 5th one is leadership. You know, these are real businesses. You know, I could do a whole dialogue with you on the dysfunctionality of the partnership model. You know, show me a $5 million firm, show me a $10 million firm with 7 partners, and any one of those 7 in the room can say no to the next new idea, but no one can say yes. Yeah. It's sometimes a rudderless ship. But it's those 5 things you have to rebuild. You know, before I was here today with you, I was interviewing a firm on the West Coast, and they said the following. They said there were 4 partners, they were all in their 60s, and they all wanted to retire in 2 or 3 years. Yeah. And I said, who is going to take your book over? First partner said, Michelle. Second partner said, Michelle. Third partner said, Michelle, you know where this is going. Fourth partner said, Michelle. My 5th call was with Michelle. I said, Michelle, you're really popular. Partners love you. She said, I know, that's why this is going to be a really hard meeting for me. I go, what's up? She says, I'm leaving. I'm going to another firm. They don't have anybody to take that work over. There is a group of firms that will work until they can't. And the mantra is, we won't be able to pass it on, but we don't want to merge up. Last one, literally sitting alive at your desk, turn the lights out. Yeah. So let me move back to your opening comment, because I don't want everyone to think private equity is, you know, the next silver bullet. B, a lot of firms will be successful with it. But private equity is really about making a better, bigger, more profitable business and sharing in the wealth of that. As you know, most of these deals we create newco. Audit, because of the alternative practice structure, goes into the LLP. Tax and consulting goes into the LLC, the legal entity.
Alternative practice structure.
Yeah, exactly. And what we're trying to do is create something that in 5 years, the stock, the rollover equity, is worth 5 times that. And these early precincts I talked about, that's what they're doing. You know, they've been at it 3 years and they've already 3x the value of the stock. People struggle with this. What they can't get their arms around is, how can you make an accounting firm that much more successful?
I agree.
Well, when you put capital, you mentioned Citrin Cooperman. Let's look at that one. They were a $315 million firm, pretty profitable, on October 1 of 21. It's now November 20 of 2024. I hope this will air in 2024 or early 25. They're now an $850 million firm. They've grown 3x. How did they do that? 67% of that growth was M&A, where they went into firms, we call them NFL cities,
Yeah.
and got the best-in-class firm who was fiercely independent, who never would have merged up. But now the economics are saying to that $15 million firm, we're getting valued at $30 million, and we're unlocking $15 million of that today with favorable tax treatment. And they're telling us that that rollover equity, that stock that we own, could be worth 5 times, 4 times. So 5 times 15 million is 60 million plus the 15 of cash. That's 75 million for my $15 million firm. That $15 million firm today was worth $7.5 million. I don't get a dollar of retirement until I'm 65, and then you're going to pay it slowly over 10 years at ordinary income tax rates. I know I went quick on that, but where they disrupted the market is they took what I call the unfunded chain letter. Come join us, get nothing. And if you vest and you're still around and the firm's still in business and the industry's around, we'll slowly pay you essentially 2 times your compensation. This is what you can get if you do nothing. This is what you can get as part of that. So the enticement is in the economic bucket. But what you really have to do is talk about the strategic bucket. Why will we be better together than apart? What can we achieve together? Is 1 + 1 = 2? Does 1 + 1 = 3? Does 1 + 1 = 11? And then there's the cultural bucket. I'm happy today. I mean, I get mad at my partners sometimes. Sometimes I have a bad day. Sometimes I feel overworked. Sometimes I feel underappreciated. Sometimes I feel undercompensated. But I'm happy. So going into that new world, that new environment, how much is that going to rock my world? So what happens when we go down a path with firms to explore this, what do I say to them? I say, look, I don't know whether you should do it or not. But what I do know is you sit on the board, you're in the C-suite, you have a fiduciary role to all your partners and your people. Go figure it out. Let's find out what it is and then come back to this table and decide what to do, right? And then decide, does it make sense for us? So I don't know if that helps you or gives you a little bit more.
No, that was
on
very
it.
comprehensive. Yeah. But I want to touch upon the alternative practice structure.
Yeah.
That, when you divide this entity in 2 pieces, practically the advisory entity and the test entity, we'll just, for the purpose of our conversation, and whatever I've seen, my limited knowledge here is practically the advisory owners control that test business as well. That's how the administrative service agreements are structured. So I just wanted to say that how, from a legal standing, I mean, 3 years in this relationship, people are there already doing this, and this is happening at even smaller firms I've seen now. So do you think this alternative practice structure, where you segment employees, but you have practically control of just original owners and the private equity to the whole business, this will have its life? That's one question that comes to my mind.
So I want to be real careful on the answer here because, invariably you're gonna do a podcast and someone sitting at the U.S. government or the regulatory bureau is going to be listening.
Yeah, no, you can skip that if you want.
No, I'm totally fine with it because I would say it directly to them.
Yeah.
The alternative practice structure, we sold our accounting firm to H&R Block in 1998. We were one of the first firms to go the way of not private equity, it didn't exist back then, but to a public company.
Yep.
And sure enough, we became part of what was then called McGladrey, which is RSM today. We had that alternative practice structure. McGladrey and Pullen was the audit company, and RSM McGladrey was tax and consulting. What the regulators wanted to protect was a non-CPA owner owning an audit company. They worried they could influence the outcome of that audit. Hey, that's a portfolio company of mine. Hey, that's a friend of mine. Could you look the other way? We auditors, and I'm a reformed auditor, we sort of scratched our head because we said, look, in the world of independence, when there's a question of integrity, doing the right thing versus economics, making money, we will always choose integrity. So we said, okay, if that helps, we'll do that structure. I mean, you know, at Citrin Cooperman or Eisner Amper, 98% of the partners are in tax and consulting, and then there's 2% that are either in both companies and maybe just a handful only in the one entity, very small number. And you know how it works. We all sell audits. It's no different than we have a wealth management business. You know, have a broker-dealer or an RIA. We have a separate entity, separate business cards. Hey, prospect, we'd love to do your audit. Great. Well, let me help you out. Mary, who's sitting over here, runs our audit company. So she'll send you the engagement letter. That'll come from the LLP. I'll be here as a relationship person with you. The way it works is a lot of the auditors actually sit in the tax and consulting business, the LLC. We'll do a budget. We'll figure out what it's going to cost. We'll requisition those people. They'll go do the work. We'll send an invoice to the LLP. They'll bill you. You'll pay them. They'll give us back 92% of that. They got to keep something behind for technical standards and training and, you know, regulatory stuff. That's fair.
Yeah.
But there's a level of protection. So here's the biggest thing I would say. We're coming up on the 30th anniversary of the alternative practice structure. And I ask every lawyer, law firm, attorney I meet that works in the APS area, has there ever been an audit gone bad because of outside ownership? And the answer is we're still waiting for that first one. So I find that lots of times we get immersed into this structural issue. And when I'm talking to an accounting firm or a private equity firm, I'm saying, let me just tell you how it works. Mm-hmm. It probably takes up too much talk time versus, you know, I'll bet on anything if I got a 30-year track record of squeaky clean. I got inside information. I know the firms that are doing these deals. I know the integrity they have. I know that no audit leader will ever be influenced when pen in hand they should write, you know, we can't get behind this opinion and give it a clean opinion. Now they're going to do it. That doesn't happen. And think about accounting firms going out of business because of bad audits. You know, you could argue it's been 22 years since Arthur Andersen, right? And with Enron, and you could argue that you know, maybe they didn't do a bad audit. Maybe those in leadership committed fraud. You know, audit is not foolproof. It's not 100% we're going to uncover fraud. We look at stuff. We look at things. But we do not look at every single thing. We guess the best we can. Yep. Before Arthur Andersen, you got to go back to 1989 to Laventhal and Horwath. So, yeah, that's probably more than you wanted to know about APS and alternative practice structure.
Yeah. So I mean, in smaller firms, these are the questions that come in. You know, because in smaller firms, if they operate, how would that happen? And some of the smaller firms, I have seen good success. Some of them are our clients. And what I feel is, some firms who want to retain control, they have specifically taken capital and gone through acquisition route, but they have maintained majority, and private equity owns minor percentage of it. I don't want to name anyone, but yes, some of our clients have done that and done really well. But one of the question comes in, if private equity is in minority, the exit route, what would the feasible exit route? I know traditional exit route, it could be buyout by existing partners. But what would, according to you, be feasible exit routes for private equity if those owners says that we continue to build upon this now?
So just to make sure I'm hearing you right, if it's a minority deal?
Yeah, if it's a minority.
How could that exit of the private equity group be different than if it was a majority?
That's one question. So basically, owners needed a capital.
Yeah.
They took the capital. They gone to the growth path. They are achieving the growth path. Now, business itself is throwing a lot of money, so which itself we continue to invest. then we can continue to grow. Their partner base has not increased too much.
So I'm with you.
So cash flows are throwing too much money. So now, how would PE? PE is also making money. So, but would now they want that we have corporatized the firm. So traditional partnership structure is not there. Well, owners are the managers, but we still have CEOs and COOs in place. The board is there, private equity sitting on the board. Now, if there is an exit route for private equity, what would be the feasible options?
So in a minority deal, sometimes in the agreement it stipulates that the accounting firm, I'm thinking of one specific one, there's a specific stipulation of what it would take to buy out of the business. You know, if you think about it, generically speaking, you got a 5-person board. 4 of the people are from the accounting firm, 1 is from the private equity. Usually their return is 11% of what they're putting in. If the business does great over the next 5 to 7 years, my guess is their return won't be 11%. It'll probably be closer to 17%, sort of like a step up. Unfortunately, if the business goes the wrong way, which, is sort of a rarity in public accounting. I mean, you got to really have a bad day at the office to screw this thing up. But I guess if you did, they would have some put or call options to take an equity position, call it 20, 30%, and take control of the business. My guess is if we stayed independent and we screwed it up that bad, we'd do other drastic things.
Yep.
So I don't know, it sort of comes out for the wash. Alternatively, buyers are the same, whether you own a minority or a majority. I like to tell people that be careful what you wish for, because I'll tell you what, a 49% minority partner might be harder than you think.
Yeah.
Every time I want to do something, I got to think about it. But can I just give you a simple, my algorithmic formula of the day?
Yep.
If you want success in this venture, here's what I've observed on the playing field. A great firm with a great strategy to grow and improve profitability, combined with a great private equity group that understands people businesses, where the assets go home every night. Actually, now they don't really go home because they stay home, but you know what I mean. And the private equity group sees great leadership and says, last thing I want to do is manage your business. I want great leadership. You go manage it. But if you have a major strategic or capital issue, call me. Let's talk about it and figure out the best thing to do. Great accounting firm that has a story, great private equity that respects the greatness, the culture, how that firm rolls. And the last piece is the most important. It's what are we trying to build? What are we trying to do? I mean, if you think about it fundamentally, you're the seller, I'm private equity.
Yep.
You need my money because you want to invest in what? Technology, transformation, talent, M&A, you name it. I'm only sort of leasing space from you for 5 to 7 years, right? And what am I in the business of? I'm in the business of growing EBITDA. So think about this dichotomy. I want to grow EBITDA. You want to spend my money. I want to leave in 5 to 7 years. How are we going to have a good marriage? Are you with me?
Yep.
So the beauty of equity, rollover equity, is we connect at the hip. Pari passu, one level of ownership. I got the same shares you got. So we are aligned. We've talked about how we're going to use that money, the sources and uses. Let's go build what we say we want to build. The problem Citrin Cooperman and Eisner Amper had is they hit it out of the park. In the 7-year goal, they hit in 3 years. You may say early adapters, they were the only game in town. I hear all that kind of trash talking. No, they got the right partner. New Mountain Capital was great for Citrin. New Mountain Capital went out and what'd they do? They bought a bigger one, Grant Thornton. Right? Towerbrook and Eisner, same thing. And we talk about those because they've stood the test of time. If I went to the class of 2022 and I looked at, Smith and Howard and Prosperity Partners and Cherry Beckert, and I'm sure I'm leaving some Shellman, I'm sure I'm leaving some out.
Yep.
they're ahead of budget. It's working for them too. So these won't all be home runs. There will be some, I won't call it a failure, but that don't hit the goal. But I think it's an important piece that private equity is not just about the capital, it's about building something together.
So one fundamental question, again, we talked about capital and EBITDA and all of that. Now let's talk about a little intangible thing. The concept of long-term ownership. Firms where have been built for generations. So I come from a bias. I've completely built my business bootstrap. Me and my younger brother, our co-founders, continue to own the business. Not that we haven't been approached. We are not an accounting firm. We work for accounting firms. So we have been approached by...
Accounting firms are your clients.
Are our clients. Yeah. So we have been approached by many. We have been approached by some of large private equity who are part of this accounting firms, PE circuit. They have approached us. We have kept it that way, and our philosophy has been doing right by the client, doing right by the team, doing right by other stakeholders has been something core where we can take a call when we don't have one more person to answer on the table. I'm not saying that when they come in it doesn't happen like that, but if that has a priority for us. And one thing also we have in our mind is our expectation. We have far exceeded in terms of what we are making than our expectation have been. So we have very clear realization that this is now an ecosystem which is building, that helps the stakeholders around it. And of course, it's creating massive economic activity around us. So that clarity, and a business doesn't need capital. If it's need capital, I'm not opposed to raising capital, my philosophy. So coming from that perspective, if the long-term ownership structure is not in place, of course the right incentive structure is needed, but with that incentive not being aligned, partners were pulling people together, keeping clients with you, with that changing. Is it going to impact the whole value system around this accounting firm business? That's one of the fundamental point of caution the smaller firms are thinking. Because, so let me tell you, I was talking to one firm in LA. I think me and my colleague Christy were there. And one colleague was a younger partner, two of them. And they said that if my elder partners are retiring, I'm going away. I don't want to, be in this. So it's like, I don't want to be that route. So yeah, just if you can throw some light on that question.
Well, you put a lot of questions into that one.
I try to be little,
The first one is your business.
Yeah.
Nobody's got a gun to your head. You're making great money. You're growing. You and your brother are having fun.
Yeah.
Keep doing it.
Yeah.
At some point, you may look at it and say, we want to sell a piece or not, or we'll pass it on to the next generation. It's just, the business circle of life, of figuring out what to do. Someone might look at your business and say, yeah, you're growing, but you could be growing a lot faster and you could be a lot more profitable if you had capital behind you. Matter of fact, if you had capital, I'm going to turn the question on you. What could you achieve today that might take 5 or 10 years to do? What could we do? Successful businesses built for speed. What's our speed factor?
Question to me?
So it's. I think if you want to accelerate the growth of a business and increase the profitability, and maybe take some chips off the table, or by combining with someone else, and it can get you to a place you can't get on your own. I think that's the decision tree going on.
Absolutely.
When you talk about Los Angeles and that younger partner, yeah, there's a lot of partners like that say, look, I need the title of partner, because when we go to the country club with my mother-in-law, she introduces me to people as, this is my son-in-law, the bookkeeper. But the day I made partner, now she says, hey, this is my son-in-law. He's a partner in a big accounting firm. So non-equity partner, income partner. I'm not an owner, but I have the title of partner. It's almost like, it's like getting a medal or something. But there's lots of those people today that want and like a job with a steady income, but don't want the pressure, the stress, the risk, the unknown of being an owner. You know, go tell that partner, let's go to the bank and put your house up as collateral and put capital in that way. No, that's not for me. So part of it is the deck of cards you have, the people you have. Are they what we call climbers and crazies, or are they just sort of content and want the security of a job and an income? Yeah.
Yeah. And I mean, I think we are running out of time, but I would like to, I mean, we can continue the conversation. There are a lot of
this is
questions
good. Yeah,
we can ask. But yeah, thank you for doing this. Thank you for taking the time out. I think I have a lot more questions because so many things are happening. We are working with so many firms where they are also having questions or they have gone private equity route. And I would say so far things have been really nice. My question, as I said, comes from the fact that a lot of people have this question in their mind. When I talk to the smaller firms, I'm always on a road trip, probably 12 weeks of the year, and meeting all my existing clients, about 150, 200. So kind of getting an on-ground understanding of what they are feeling. So,
I will tell you, I know a lot of your clients, and they rave about you. They rave about the quality of service. They rave about your responsiveness. And they also rave a bit about your creativity.
Oh.
You know, sometimes in business it doesn't go the way we thought.
Yeah.
And you're really good at sort of saying, okay, let's figure out how we're going to solve this issue or problem.
Yeah.
So kudos to you. I've admired your story, your history. It's a smashing success. And, you know, I just think great things ahead for you.
No, I think, thank you so much. Again, I mean, this is always all stakeholders coming together and making it a little successful.
Yeah.
I will always say we have been fairly lucky as founders and the team, what we have done, and all clients and team that has come together, right time at the right place, things happen. But thank you, Allan.
Thank you.
I want to let you go and enjoy your PE Summit. We are there at the PE Summit, but thank you for taking the time out. Thank you for sharing that insight. That was Allan Koltin with us firsthand. We learned a lot of insights from him, and I'm taking a promise from him that we'll meet again virtually, maybe.
Love it.
Sometime in future. Yes.
You got it.
Thank you.
Okay.